So you could also say, why not just invest in the US? The challenge with that is you're investing for the long term. A lot can happen in 10 years. There was a time when Japan was the US of the global stock market and it was driving the bulk of the growth. Today, Japan is less than 6%. This is nowhere near the US. So if you assume that the US will always be leading the global stock market, you might be wrong. Hello everyone, my name is Modupe, and today we're finally answering the question that people usually ask first when they think about investing. What should I buy? Now, let me set some expectations. We're not going to try and predict the next Nvidia or the next Tesla or Netflix. Today is about choosing something you can set and forget that won't require constant attention, constant research, constant monitoring over the years. A quick reminder before we start. Everything we cover is for information and education only, and it shouldn't be taken as financial advice. Investments in the stock market can go up as well as down, and your capital is at risk. If you do need personal financial advice, please consult a licensed professional. Now, before we go on, I need to explain the concept of index investing and ETFs. An ETF means an exchange traded fund. It's basically a group of many companies, a basket of many stocks that is bundled together as one single investment. So instead of buying individual stocks, when you buy a unit of an ETF, you're buying a group of stocks. So the idea behind an ETF is this. Instead of you trying to identify the next Tesla, you simply buy a group of companies knowing that one of them will probably be the next Tesla. And while the others may lag behind in terms of performance, the overall group will move in line with the direction of the highest performer. So the person that buys Nvidia, for instance, would probably have made more than someone that bought S&P 500. But then the chances of you being the person that bought that Nvidia out of all the millions of people and all the thousands of companies on the stock market, very slim. If you're fortunate enough to have picked Nvidia once, the chances of you doing it a second time are even far slimmer. But with this kind of investment strategy where you pick a group of companies, you don't have to keep trying to pick the next best thing, because whoever bought the market would have still benefited from Nvidia being in that pool. The person that invented this idea is called John C. Bogle, and he said, rather than try to find the needle in a haystack, why not buy the entire haystack? Instead of you trying to identify which individual company is going to have the best returns in the next 10 years, remember this is a long-term investment, you might as well just buy all of the companies in that group, and then we know 1 or 2 or 3 or 7 of them will eventually turn out to be great. So right now, most of my long-term investing is being done through ETFs. When I was in Nigeria, it was slightly different because it was a bit easier there to identify which companies were not going to make it. A lot of the companies listed on the stock market in Nigeria did not have the kind of cash that US companies or global companies have these days flooding in from investors. They didn't have a lot of leeway to not perform. Once they are not performing, you would see it in their numbers. But when you're investing globally, it's slightly different. A company like Tesla, for instance, went many years before they ever declared a profit. Same thing with Amazon. So sometimes you need to stay invested in some companies, but you don't want to pull out your funds too quickly. You don't want to put in your funds too soon. The easiest way to avoid those mistakes is buy the market. Now, when you buy the market, instead of betting on one company, your risk is spread across companies. In some cases, it's spread across countries. And in a lot of cases, it's even spread across industries. With a global ETF, your diversification works in 2 ways. One, your risk is spread across all the companies in the ETF. So one company collapsing will not affect your investment significantly. But then, in addition to that, you're also diversified across countries. So if something goes wrong in one country, let's say a country goes into a recession, but another country in a different continent is fine, then you're fine. Your portfolio still remains healthy. Now, a quick thing to note. Diversification is not a guarantee. It reduces your risk and allows you to still benefit from growth. But instead of economic downturns that affect more than one market, And in some cases, it acts like a contagion, like we experienced with the 2008 real estate crisis in the US and the UK, right? It started in the US, but then affected the market in the UK as well. But you get a bit of resilience and you're able to hedge your bets. There's something Warren Buffett said. It's not a very flattering statement, but he said diversification is for people who don't know what they're doing. But then he also said that for the average investor, they're better off just putting their money in a low-cost, diversified index fund. Now, he's contradicting himself, but he's not. The average person doesn't know what they're doing when it comes to the stock market. People within companies that you are investing in some cases, we find out do not even know what they are doing. Not to talk of you, that you are outside the company and you are investing in it. The reason Warren Buffett can go hard is because he analyzes the company and then buys as a stakeholder in the company, not just buying shares on the market and leaning back. In some cases, they get involved in the running of the organization. Berkshire Hathaway was one of the companies he invested in. It wasn't just a company that he founded by himself. He saw the company, invested in it, and bought it and turned it into an investment firm. I think it started off as a paper mill or something in the past. So he is someone that when he says know what they are doing, his standards are not the standard of the average investor. Now, the thing about diversification is it's not a guarantee that you will make the most money. The person that invested in S&P 500 probably didn't make as much money as the person that invested in Nvidia. But then you're also not taking on as much risk as the person that is picking individual stocks. So it's more likely that person will lose their money completely than you would. You both experience growth in your portfolio. Your money stays safe. They grow more, but they have a higher risk of losing their money. So that's the trade-off between diversification and identifying or trying to select winners. There are two broad types of ETFs. So you have active ETFs and passive ETFs. Now, active ETFs are managed by people who believe that they can beat the average market trend. Personally, I avoid those because what they do is basically some professional goes, they pick a bunch of stocks and they more or less assemble a portfolio of companies and then they offer it to retail investors, people like me, and then they charge a fee. The challenge is this. One, you're assuming that they know what they're doing and they know which companies to select. Historically, their performance hasn't really outperformed the average retail investor. I first learned about that statistic when I was in university, that the performance of active professional investors when they select companies has not been better than a layman just randomly throwing darts at a wall. But then what makes it worse is you are paying a fee. And if you remember our principle that returns on your investment can actually be influenced a lot more by things like what you keep than what you make. So for instance, in this scenario, your assumption is the portfolio that they've selected will not only beat the market, but it will also add an extra to compensate for the fees that they're charging you. And a lot of these people charge fees as a percentage of the assets they're managing, which makes it completely worse. So no, I'm not a fan of active ETFs. And then the second type are passive ETFs. Now, the way these work is basically there's an index that tracks a group of companies based off their market capitalization. Market capitalization basically means how much money has been invested into that company. So how many people globally have bought shares in that company multiplied by the share price. So the index tracks a group of companies. There is no human being trying to make a call here or there. You just have an index that is tracking those companies. Usually they're very low cost because there's no active work involved in maintaining the ETF. The ETF is just tracking the index. It's just buying shares or all the companies in that index according to their market capitalization, that's all. So usually the fees are lower. Your average active ETF might be like 0.6, 0.7% in terms of fees, while your average passive could be like 0.2. So when you look at it that way, active investments in some cases can be like 2 or 3 times the cost of a passive ETF. The other bit to look at is the ETF accumulating or distributing. Now, in this case, I have my preferences and they've changed over time. In terms of what it means, accumulating ETFs are ETFs where if the companies within that ETF pay dividends, when they pay dividends, those dividends are automatically reinvested back into the ETF. So you never see dividends in your account if you buy those kind of ETFs. You just be seeing the price going up. Distributing ETFs are the exact opposite. When the companies within the ETF pay dividends, they pass on the dividends to you. So you could have two ETFs tracking the same index, but the share price will be different because one is constantly paying back the dividends. So the share price will slightly lag the one that is reinvesting it, but they will trend in the same direction. They'll both go in the same direction. It's just that the prices will be slightly different. There's no right or wrong answer for this one. I used to like to see my dividends. I would see the dividends in my account, but I would still end up reinvesting it back because I never withdrew that money from my ETF. Unfortunately, sometimes that required me to make an active decision. Okay, now I need to reinvest this money now. Meanwhile, if I just simply bought an accumulating ETF, the thing is automatically reinvested for me. I don't have to think about it. So that's why I personally prefer accumulating ETFs, because it's automatically reinvested and you can see the compounding effect of not just the share price going up, but also the dividends being reinvested into that ETF, and then the overall value of your portfolio grows with time. Also, at this stage where you're just starting off in the stock market, you're not aiming for recurring income, which is what dividends are. You're aiming for growth. If you want to invest in dividend income, the mindset is slightly different in terms of how you select what to invest in, right? There are dividend ETFs, they exist, but personally, I don't think what you gain from them is worth the effort, but some people do. In my own case, when I do want a stock market investment to give me dividends, I usually would prioritize what I've said we shouldn't do, which is selecting individual stocks. And that's what I have on my trading 212. I have a portfolio of stocks that I've selected that are all dividend paying. But the risk with that is a lot higher than with an ETF, with a globally diversified passive ETF, because that's me actively investing. The bulk of my money sits within the growth, the accumulating ETFs. It's just a little bit of money I put over there just to keep track of those companies. But for now, your focus is to build growth. The other thing to look at here are the fees. So when you see TER, when it says TER, TER basically stands for your total expense ratio, which is basically how much in percent the ETF charges for admin costs, management, and things like that. This is not the platform charging, it's what the ETF itself is charging. If you check something like FWRG, the TER is 0.15. So 0.15% of whatever you spend on this ETF is the fee. Personally, it's another area where I like to keep things as low as possible, because if you check, let's go back up and look at an active, let's see if we can find, typically you find out that, so if you check something like ARC, which is a very niche ETF, they're looking at futuristic technologies and things like that. The risk of the companies failing here is higher, because you could have 100 companies and only one of them survives. There were a lot of companies that tried to do electric cars before Tesla did, right? There were a lot of companies that tried to do space exploration before SpaceX. So the chances of failure is higher. The cost is also higher. So the TER here on average, 0.75, 0.75, a few are 0.45. But when you're comparing that 0.45 with 0.15 that you get when you invest in a globally diversified ETF, then you start to see that maybe it's not worth it. So personally, I lean towards lower fees. Now, when it comes to yield is how much dividends you can expect. Right now, that's not a priority for an ETF portfolio. So the other thing to note is the level of diversification. Do you want it diversified across one country, or do you want it to be diversified globally? So if you look at something like the S&P 500, the S&P 500 is the 500 largest companies in the US. That's diversification across one country. Then if you look at something like the FTSE 100, that's the top 100 companies in the London Stock Exchange, in the UK stock market. That's also diversification across a country. Now, You could say, why do global diversification when I'm in the UK? Let me invest in the UK. So I buy the top 100 companies in the UK. But if you look at the size of the UK within the global stock market, the UK only represents about 4% of the global stock market. The largest companies are actually sitting in the US. The US represents about 60% of the global stock market. And that's where a lot of the growth comes from. So you would miss out on a lot of growth if you just focused on UK. So you could also say, why not just invest in the US? After all, that's where the bulk of the company sits, driving the bulk of the growth. And it wouldn't be a wrong assumption for now. The challenge with that is we're investing for the long term, over a 5 to 10 year period. And a lot can happen in 10 years. There was a time when Japan was the US of the global stock market, and it was driving the bulk of the growth of the global stock market. Today, Japan is less than 6%, still doing better than the UK, but it's nowhere near the US that is now driving the global stock market. So if you assume that the US will always be leading the global stock market, you might be wrong. There are concerns at the moment that the US stocks are already overpriced. They're already priced too high. That's why we had a lot of fluctuation in 2025, because investors were a bit unsure. So that you're not worried about if one market is overpriced or if another market has a future, simply buying a globally diversified ETF takes care of that risk. What you lose though is you lose the current immediate growth that the US has. Because if you look in the last 5 years, the US has outperformed the global average. So while the global average was roughly about 7 to 9%, the US was doing like 10 to 11%. The US was always like 3 percentage points ahead. But then you're still doing better than inflation, you're doing better than bonds, you're doing a lot better than you would be if you had stuck with keeping your money in your bank account or keeping your money in bonds. If you do have the appetite to keep tracking, watching what's going on in the world, you may want to say, okay, fine, I'll put my eggs in the US basket, and then if things start to go awry, I'll pull it out. But then a lot of people that had their eggs in the Japan basket never knew when the market was going to collapse. So it's still a risk. Either way, you still benefit from whether it's Japan, US, or UK. You still benefit from their growth so long as you have a globally diversified ETF. So if we look at the criteria again, we've talked about passive ETF, not an active one. I'm looking at one where the cost, the TER, the expense ratio is low as I can get for that particular index. It must be globally diversified. And like I said, I would prefer if it was accumulating so that we can get the compounding impact over time. It can be distributing, but we'll stick with accumulating for this exercise. Now, let's buy our first ETF. So if we go back to our account on Invest Engine, under investments, you already see some popular ETFs here. You can list all 800 ETFs that they have. Let's see, asset class, we're looking at equities, not alternatives. So that removes things like gold, removes bonds, removes cash. You see the most popular one here is Vanguard FTSE All World. And next to that is Invesco FTSE All World. Now a quick explanation about FTSE and MSCI. The way it works is this. An ETF, right, an exchange traded fund, tracks an index. That index is basically a list of companies and then their market contribution, their weights, their contribution to the total index that the ETF is tracking. If we say in this case, we're looking at the FTSE All World, right, which is an index of all the large and medium companies in the world, both developed markets and emerging markets. But then that index is maintained by someone. So what happens is you have a company that is providing the ETF, and then you have another body that is maintaining the index. If we look at this first example here, your Vanguard FTSE All World, right? So it says this ETF offers investors broad exposure to a diverse range of companies across both developed and emerging markets worldwide. Now, the issuer in this case is Vanguard. So Vanguard is providing the ETF. They are issuing the ETF and they're charging 0.19% on it for every investment you make on it. Now, the index itself is the FTSE All World Index. That index is maintained by a separate body called the FTSE Russell. They maintain the index, the list of all these companies, across all these countries. They said the index broadly consists of about 4,000 large and mid-cap companies across 45 global developed and emerging market countries. It excludes Russia and frontier or standalone countries. Frontier is like the level after emerging markets, right? So emerging markets are your China, Russia, India, Brazil. Frontier markets are lower than that. The risk of investing in them is a lot higher. The classification is usually done based off things like the risk of investing in the markets, the stability of the economy, how independent the companies are so that governments are not interfering with the activities of the companies and so on. That's it. So those are the 4 things you need to know. You have the index and the ETF, and then you have the issuer of the ETF, and then the person that maintains the index. So when you see a name like Vanguard, FTSE, or World ETF, basically what that means is Vanguard is the issuer, they're issuing this ETF. The index is being maintained by FTSE, and the name of the index is the All World Index. And then next to that is Invesco FTSE All World, which means the same index, All World Index, maintained by FTSE, is now being issued by Invesco. So here you have MSCI, which is another organization that tracks indexes. So MSCI also has their own list of all world markets, and you also have other ETF issuers that provide indexes from MSCI. It doesn't matter which one you choose between the two. The information is usually very similar. So we've seen different types. So here you see this, for instance, MSCI ACWI. It's essentially the same thing, but now the index provider is MSCI. ACWI is all country. Let's see what it stands for. It's the AC stands for all country, but it's basically like all world. So the index is also designed to give investors access to a broad range of companies from across the globe, providing exposure to both developed and emerging markets. So it's basically the same definition as your all world coming from FTSE, but now this is coming from MSCI. They track fewer companies, 2,700 securities, but if you check the performance over time, it's typically the same. It's roughly the same trends, and it's roughly the same companies as well. Let's see, if we open this side by side, yeah, so if you check these two, for instance, you see the trends are very similar. It goes up, down here, like it's practically the same. And then if you check the companies, the top companies there, it's going to be similar as well. All right, so you have Nvidia, Apple, Microsoft is practically the same, but it starts to differ slightly in terms of contribution. So here, Nvidia is 4.8, here Nvidia is 4.3. Broadcom is above Alphabet in the FTSE. Alphabet is above Broadcom in MSCI, but it's roughly the same set of companies. The regional splits too are very similar, 60% roughly for North America, 11% or 10% roughly for Europe, and same for Asia, 5.7, Japan, and so on and so forth. The UK is usually around that 3.5, thereabout, and same with the sectors. So it doesn't really matter much which you buy. I just have a preference for the FTSE. I also like the fact that they classify South Korea as a developed country, but MSCI doesn't. MSCI sees it as emerging. If we go back, so we said equities. You can select your provider here if you have a preference for one. Currency hedged, I didn't mention that, but what that means basically is that if you're investing in something in a different economy or in a different currency that is not the pound, they will try and compensate for exchange rate differences. This usually comes up when you're investing in things like commodities or like gold, silver, and so on, where the bulk of the gold, for instance, is traded in dollars. But if the exchange rate between pounds and dollars is changing while the price of gold is also changing, then you may not benefit from the full growth that you are getting in gold. Could apply with ETFs as well, but not with the ones we are interested in. The ones we are interested in are denominated in pounds. And then what I also like to do is sort by the TAR. So I look for the ones that are cheaper. If we skip all the S&Ps, you have these two, both tracking the same index but provided by different people. Some people would prefer to go for Vanguard because Vanguard is older and people know it. I would go for Invesco because everybody is regulated and they are both buying the same index. So I'll just go for Invesco and that's it. And you have Invest Now. Now, if you're on a different platform from Invest Engine, you can simply go to where the offer options are and search for FWRG. So I just type FWRG, because another thing is if you search for FTSE Hot World, it could give you Invesco, it could give you multiple ETF providers. On some platforms, they may also give you that same ETF but denominated in the wrong currency or in a different currency other than pounds. Sometimes when you're searching stuff on blogs and websites, because a lot of the internet has been fed by people in the US, right? So you see people listing things like VTO, which doesn't exist in the UK, but it's still tracking the same ETF that we have versions of in the UK. So what I do is memorize the actual acronym, go to the search field panel for your platform, type in either FWRG or ACWI or VWRP. Those are all globally diversified low-cost ETFs. Confirm that it's the accumulating version you want, confirm that the TER is low, and that it tracks the global ETF. Just read the description like we did for Invest Engine, and then you go ahead and invest. Now, there are two ways you can invest. You can either do dollar cost averaging, dollar cost or pound cost, or averaging basically, meaning you buy a little bit every month, which is something that I do both really, because you have the option of you add a lump sum once. So let's say you had a bonus. You have £5,000 you want to invest once and just forget about it. But you have the whole £20,000 you want to put in your ISA. Just put the £20,000 once and go to sleep until next year. You don't need to look at your portfolio. Alternatively, you could make it a regular occurrence. So you pick a frequency, usually monthly, set it up in such a way where on a particular day, you're transferring a fixed sum of money. Usually what I do here is, as I collect my salary, I set it up for the day after I collect my salary. I know when my salary comes in, if it's £200, £500, or £1,000, whatever the amount is that you want to invest on a monthly basis, that amount is automatically deducted from your account. So both of them have their pros and cons. The benefit of lump sum is that you get to benefit from the full impact of whatever growth the market experiences over that period of time. Unlike when you're doing dollar cost averaging and you only get the portion of the period. So for instance, we already established that time is your biggest ally when it comes to investing. So if you invest £20,000 today and you check it after a year, that £20,000 has been invested for 12 months. If you invest £2,000 every month till the end of the year, by the end of the year, you would have the £20,000 invested, but the one you invested in October would have only been in the account for 3 months. The one you invested in July would have only been in the account for 6 months. So you wouldn't have gotten the full benefit of whatever growth happened in that period. But the reason someone else does it like that is the first option assumes that it will always be growth. But then you could also have downsides in that period of time. So if you invest the full 20,000, you would also be hit by the full impact of the downside during that period. But if you are spreading it across the year or over time, what happens is when the market is up, you're buying. When the market is down, you're buying. On average, you don't get hit significantly. The truth is that either way, it doesn't matter, because you're not investing for ups and downs of 1 year. You're investing over a 5 to 10 year period. By the time you've invested, the person that put the 20K once and the person that was drip feeding it over time, both of them would probably come up about the same over a long enough time. Over a long enough time frame, although there's a slight edge that the person that put the lump sum in will have, because though they will be hit more by the impact of whatever temporary downsides happen, they already have that money locked in and they would actually benefit more in the long run. But it's usually marginal in terms of the difference. What I prefer, or what I try to do, is to have the discipline. I think that's what's the most important thing here, to have the discipline of investing regularly. Whether you're doing it monthly, once a year, so long as you're doing it regularly, that's the most important thing. So if the dollar cost averaging is going to help you to do it regularly because you just automate that deduction every month, then that's good. The important thing is you don't want to be consciously making a decision to invest every time. You want to set up automation that removes that decision making from your hands. Systems beat willpower any day of the week. So while there's some evidence that lump sum investing outperforms dollar cost averaging over a long enough period of time, the behavior is really the most important thing we're trying to establish. So you're automatically building your emergency funds on one hand, and you're automatically building your long-term investments on the other. So the two gears of your engine of growth are both automated. So you're done. You are now officially a global investor. You've gone from just learning about investing to actually being an investor. You don't need to check your portfolio every month. Once you set up that automated investing, you can leave it to run over time. What you could do is, as your income grows or as your appetite grows, you can increase what is automatically invested every month. I was listening to someone once who said that they know they've done a good job investing when they've forgotten the password to their brokerage account. Now, I'm not asking you to forget the password to your brokerage account, but you don't want to check it too frequently because you would be tempted to tinker with it when you're checking it every month. So this kind of exercise, you set it up and maybe check it once a year. Since it's a 5 to 10 year investment, check it, make sure your investment is still on track, and just increase how much you put in regularly. As your salary increases, you increase how much you put into it. So that's it for today. We've covered a lot, but there'll always be one or two questions that you might have. Leave them in the comments below. We'll tackle them together, and we'll talk about some common pitfalls that people face when it comes to investing in the stock market and how to avoid them. I'll see you then.